Hello and welcome to the Opening the Gates May 2026 UK property market update, where I'm going to be talking all things house prices and activity levels across the property market throughout the month of May and year to date. Apologies for my croaky voice, I'm feeling a little bit under the weather, so if I do take any water through this, that is why. So let's jump straight into it and I will share my screen, he says. And there we go. Right. So, as always, starting on May 2026, activity levels. So, for those of you new to watching this, from left to right, we've got month on month, middle, we've got year on year, and then right hand side, we've got May versus a 21-26 average. So, in terms of on the market, that means number of properties for sale across the period. Up 2% month on month, 1.2% year on year, and 21.5% on the 21-26 average. It shows that stock levels are healthy. They are higher than they have been in recent years. Probably says every single time I record one of these, they're at a decade, dozen year high. So there's plenty of choice out there for buyers, which is good news because it gives them more negotiating power, which hopefully means that there's going to be more activity in the market, but it does mean sellers need to price more competitively. In terms of new listings, down month on month by 4.5%, down year on year by 4.2%, but up 4.6% on the 21-26 average. So slightly down in the nearer term, but good to see, but it's actually slightly higher than the 6 year average. Nothing really to write home about there. It shows that there's definitely still sellers in the market, but they're not flooding the market as they perhaps have done so in a lower interest rate environment and where there's been stamp duty holidays. Sales agreed, this is a really positive to see because whilst new listings went down last month, they're actually up 1.7% month on month. So that's a really positive sign of potentially things to come, which I'll touch on in more detail as we run through. Down 8% on a year ago, which highlights that the higher interest rate environment is having an impact on buyers. So it shows that properties do need to be priced competitively if you're going to entice a buyer to part with their money. And then down almost 6% on the 21-26 year average, which basically is reiterating what I have just said. In terms of price changes, up 5% month on month, actually down 1.6% year on year, which is very rare. I see that when I've been doing these recordings, but still up 31.5% on the 21-26 average. So it shows that there's still plenty of price reductions happening in the market. Now, as you know, with these recordings, I am normally a glass half full rather than a glass half empty. You can see across the board from month to month, year on year, and the 21-26 average, withdrawals are actually reducing. Price changes are on the up, which highlights to me sellers are being more realistic with their pricing once they've not got their property sold. And rather than just coming off the market, they are maintaining their stance of wanting to move home, which perhaps is why stock levels continues to still be higher whilst new listing levels have dropped. But it shows that there are committed sellers out there. Fall throughs up slightly 2% month on month, down 12.5% on last year, and down 4.5% on 21-26 year average. So fall throughs, normally this is pretty similar story every time I record one of these. I bore people with it, but if you price reduce a property, it's more likely to fall through. The longer it takes to sell, it's more likely to fall through. And if you're not using reservation agreements or have your sellers legally ready, you definitely should. Those are three quick wins to get your fall through rate reduced. I work with plenty of agents around the country who have got single digit fall through rates. And when you consider that there's plenty of agents out there with 25, 30, 40% fall through rates, that can have a massive impact on your bottom line, your revenue, and your profit. So if you want to find out more about that, please do give me a shout. Now, I'm going to touch on year to date, which is actually on my other screen. But in terms of year to date, properties for sale are up year on year 2.5%, on the 6 year average 19.7%. New listings are still 2.6% up year on year and 10% up on the 6 year average. Sales agreed are down slightly year on year by 3% and also 3% on the year to date average. Price changes are up 0.5% on last year and up 29% on the 6 year average. Withdrawal numbers are down 6.2% year on year and up 5.7% on the year-to-date average. And then fall throughs are down 9.5% year on year and 1.5% on the year-to-date average. So just going to give you a highlight there of what's been happening the first 5 months of a year as well. So on to new listing average asking price. So a year ago, the average asking price of properties that came to market in May 25 was just shy of 454,000. Last month it was 451,500, and then the month just gone in May it was 460,000. So month on month we're up 1.9% on new listing asking price, and year on year it's up 1.4%. So there's some steady growth there in the market. Pounds per square foot was 392 a year ago, 405 last month, and then 415 in May. So that's a 2.5% increase month on month and 5.9% increase year on year. It's really good data to be highlighting to anyone out there who is concerned about the market not quite doing what they want it to be doing in terms of wanting to enter it, because there's always going to be doom and gloom out there from certain commentators, newspapers who love to sell a negative story, but the market's crashing. Certainly doesn't look that way, and I've been reporting on this for a few years now. So agreed average asking price. This is the average asking price, not price achieved, average asking price of properties that went under offer in these months. So May 25 was 369.5, last month was 361.5, and then in May it's at 372. So that's up 3% month on month and 0.8% year on year. So it shows that there is definitely buyers willing to part with their money. If they see good value for money, even though there's lots of choice out there, even though interest rates are higher, they will pay good money for something if it's offering good value for money. Pounds per square foot sat at 344 a year ago. Last month it was 350, and then in May it's 356. So average pounds per square foot is up 1.7% month on month and then 3.5% year on year. So again, some healthy, modest house price growth there, which is good to see, because that middle market of people who are looking to upsize from a 2 bed to a 3 bed, 3 bed to a 4 bed, they need some sort of equity growth in the market to entice them to move. And selfishly, from an estate agency point of view, we want more transactions in the market. Modest house price growth is going to do that. And then obviously from an economical point of view, more people moving home pumps more money into the economy, which is a win-win. Right, 12-month net mortgage approvals. So mortgage approvals, again, just looking at my other screen, mortgage approvals were just shy of 66,000 in April. That is the best best April since 2022 for mortgage approvals. And it is the best month for mortgage approvals since September, which is really, really good to see. And then in terms of month on month increase, it's up 3.8%. Year on year, it's up 8.9%. Got to remember though that this time last year was obviously the hangover from the stamp duty holiday or deadline, which I'll come into in some more detail when it comes to transactions. And then 10-year net mortgage approvals up 10% on the 10-year average. And April was 3.3% up on the 12-month average. So mortgage approvals are moving in the right direction, even with all that uncertainty out there, even with higher interest rates, which is really, really positive to see. On to transaction numbers. So again, just go to my other screen. So transaction numbers in April were 101,000. That is the best April for transactions again since April 2022. And in terms of the percentages, it's going to be a bit crazy here. Month on month, it's down 2.9%, so not massive change yet. Year on year, it's up a whopping 53.2%. But of course, we had the stamp duty hangover versus a 10-year average is up 10.2%, and versus a 12-month average is up 4.4%. So really positive signs there in terms of transaction levels. Really, really good to see. So even with the uncertainty of the war in the Middle East and higher interest rates in recent months, we still got transactions that are moving, which is good to see. Onto inflation. So inflation surprisingly dropped from 3.2% to 2.8% in April, which is really, really positive to see. I think a lot of the noise coming out of Governor Andrew Bailey, MPC, etc., is that there is going to be a pause on base rate, which is really, really positive considering the uncertainty we've had over the past few months. And then lastly, the house price index update. So home.co.uk is missing from this one because there was no update from them in May, unless I missed it. So you've got Rightmove up on month, slightly down annually. Zoopla static month on month, up 1.5% annually. Land Registry 0.4% down month on month. And I don't know if that is an error on my part where it says zero there, but we will have the figures on one of these tabs, which I'll double check. Nationwide down 0.6% month on month, still up 1.7% annually. Halifax down 0.1% month on month, annually up 0.4%, and then eServe month on month up 0.2%, and then annually 1.7%. So the average UK house price based on the indexes, which can be from mortgage approved data, completed data, asking price of new listings. This is why I put it all together. It's good to get half a dozen from the top of the funnel all the way down to the bottom to see how they marry up. Down 0.05% month on month, so not really a change there, but still up 0.83% year on year, which is good to see. Again, that modest house price growth that I spoke about. So what I'm going to move on to now is actually where we are with interest rates. I think I might have touched on this in a previous recording. I think it's super important to look at. So yesterday, so closing 2nd of June, the average mortgage rate across Moneyfacts was 5.59% compared to 5.66% a month ago. So it has been creeping down slowly but surely. But if you actually look at where it was just before the conflict in Iran really started to kick off, it was at 4.89%. That is when interest rates stopped coming down. And then we had obviously March, April, May. Now, if I look at the 2-year fix at 4.83% versus the 5.67%, that has taken a monthly mortgage repayment on a 300 grand house with a 10% deposit from £1,552 a month to 1,656. Read my own writing. So the average monthly repayment has gone up £104 a month on a 2-year fixed rate, or it's actually reduced buying power by about 7 to 8%, which is really, really important to understand because if that person buying wants to keep their mortgage repayment the same each month, their buying power has gone from buying at 300 to 277 500. So someone who was on the market for a few months, you might say to them, look, those same buyers who were looking a few months ago, their budget has dropped by 7 or 8%. If you want to keep in line with the market, you've got to adjust accordingly. That's really, really powerful data to be utilizing. In terms of interest rates as well, so if we look at the average 2-year fixed rate, a couple of years ago it sat at 5.91%. It's now at 5.78%. Yes, it is a little bit more expensive than it was a year ago, and then also back in the late autumn. But remember, people were still buying houses 2 years ago when money was a little bit more expensive than it is now. And in terms of products on the market, there's actually a healthy amount of products out there as well. So some real, real positives out there for the mortgage market as well. And there's plenty of lenders who are starting to cut interest rates. The other thing I will look at on this is just to consider in terms of remortgaging. If you look at someone who was on a 5-year fix in 2021, so bought a property at record low interest rates, stamp duty holiday, the craziness of COVID, they've got a 5-year fix. It was at 2.57%. It's now at 5.7. So on a 200 grand mortgage over 30 years, looking at an extra £363 a month. You imagine if they were borrowing another 200 grand and looking to upsize, they're all of a sudden looking at an extra £726 a month on their mortgage, which is why sellers need to understand the importance of pricing to enticing. And if we look at the 2-year fix as well, money is actually a little bit cheaper. So someone who bought a property in 2024 at 5.91%, their mortgage now at 5.81% would be £13 cheaper a month. So win-win there. And then the last thing that I'd recommend to keep an eye on is Rightmove's mortgage site. So a 2-year fix, they're saying is currently an average of 5.12, 5-year fix at 5.14, slightly down week on week, but yearly up about 0.5%. So that's going to impact buying power by about 5%. So a 300 grand house, if they want to keep their mortgage payments the same, they're looking at about a 285 budget. And then the lowest fixed rates at 4.32 on a 2-year and 4.45 on a 5-year. So again, about 0.5% up on a year ago. Those lowest rates had threes in front of them before the war in the Middle East started, and then the average rates had a four in front of it. So that's the psychological barrier that you might have heard me speak about before. You've then got the different LTVs down here as well, which is good to look at as well. Right, onto the house price index updates. Just zoom in on this. So Rightmove reported sales agreed remain steady. They're 4% below last year's market, but up 2% from 2024, which is good to see. The number of sales agreed in the heavily mortgage-dependent first-time buyer sector is continuing to hold up, but it's dependent on lenders continuing to lend at higher LTV ratios. Buyer choice is at its highest for this time of year since 2015, and 32% of existing homes for sale are seeing at least one price reduction happen. New sellers need to price more competitive, as already said, as over-optimistic initial pricing is leading to longer selling times. Excuse me. The average price of a property coming to market is up 1.2% in May, exceeding the typical 10-year May increase of 1%, as market confidence remains surprisingly strong. However, prices have fallen 0.3% on an annual basis. Just going back to first-time buyers as well, in that sector, they've seen an annual drop in average prices of 0.7%, which is helping to ease affordability at the entry level, contrasting to 0.3% national fall in prices market overall. And then Rightmove's daily mortgage tracker on their index says that two-year fixed rate has dropped to 5.18% from the 5.42% last month. So proving a small but welcome boost to buyer confidence and affordability. If I scroll down here, this bit I want to touch on. Homes priced realistically from the outset tend to sell far more quickly. Obviously, with properties that require price reduction, spending an average of 127 days on the market compared with just 36 for those that did not need a price reduction, a gap of around 3 months. Really, really important data to be highlighting to a seller in the living room. Do you want to unnecessarily add 3 months to your journey? Do you want to unnecessarily have to change estate agents? Do you want to unnecessarily increase your chance of falling through? Do you want to unnecessarily damage the value of your property? A great saying from a podcast guest I had, Tommy Lawrence. Tommy, if you're watching, hello. Selling quickly is not selling cheaply. You're at the height of your negotiating power. It's better to sell to that buyer in week one, week two, than it is in month three, month four, because the buyer is the one who holds the playing cards. Right. Moving on to this bit, I'm just going to read from Colleen Babcock. Prices are rising in the north, but all sellers should note that buyer choice is now at its tightest level for this time of year since 2015. Getting the asking price right from the outset is therefore increasingly important, as home prices too ambitiously are taking longer to sell. Their research shows that a home that's being reduced takes an average 91 more days to sell than a home that hasn't needed to be reduced. That's where agents have a key role to play, working closely with sellers to set realistic prices from day one to help homes to attract immediate interest and sell more quickly. I just really wanted to reiterate that point. So 4% down on last year, but 2% up on 2024. Remember when we're comparing to last year, again, we did have that craziness of stamp duty holiday. And on the first time buyer side of things, they're 4% down year on year, but only 1% lower in 2024. So it shows that higher interest rates are not impacting the market as much as people think they might do. That is the Rightmove House Price Index. So on to Zoopla. Let's zoom in on this. So buyer demand is down almost 10%. New flow of homes listed for sale up 1.2%, and then stock up 3.4%. Sales agreed up 1.1%. So it highlights that whilst buyer demand is down, the buyers, if they see value for money, they are buying, as I said earlier. So sales agreed are 1% ahead of last year, despite that buyer demand being down. There are 6% fewer first-time buyer inquiries, but those who are active at targeting homes are actually a little bit more expensive than last year, which is interesting to see. So housing market, as always, is holding up in the face of uncertainty. There's fewer buyers out there, but those that are there are definitely taking action when they see something that they like. So you can see the first time buyer information here across the UK. Median price is 4.3% higher. UK average is 1.5%. So we keep talking about how hard it is to get onto the market, onto the ladder. First time buyers are still there. Bank of mum and dad, bank of grandparents, rents were crazy high. If they're able to buy, they are buying. It's the just good old fashioned British mentality of invest in bricks and mortar. Interesting here as well in terms of first-time buyers not compromising on what they want to buy. Outside London, over half are looking to buy a three-bed house, identical as last year. You think flats, as just so many flats on the market, leasehold not performing well, buyers are skipping and have done for quite a few years now. They're skipping that first entry, what they usually used to do, which was a flat. It's going straight in and buying a house now. Why would they buy a flat that's not going to increase in value when they can go a little bit further, buy that house, increase equity, and then not have to move again, pay extra money on the whole moving side of things? So higher borrowing costs have led some first-time buyers to delay moving decisions. First-time buyer demand is down 6%. But again, like across the whole market, those first-time buyers, if they see something, they're going to act on it. And then this is a really, really good picture to be highlighting to sellers as well. So sales agreed, as I've already said, are running 1% lower than last year, despite buyer demand being 10% lower. So the conversation you need to be having with sellers is if you price right, whilst there's less buyers out there, they'll see the value for money, they will purchase a property. So committed movers are pushing ahead with purchasing ahead of last year, despite the wider caution that we've got. So you can see what happened with the mini budget. You can see that sales then rebounded as mortgage rates fell. Then we had the autumn budget, and then we've got fewer buyers now with the conflict in Iran. That is just a small snapshot of the past few years. If you actually went wider back and we said COVID, we said Brexit, um, we go back to the 2008 recession, we're never 5 minutes away from a crisis in modern history. So it shows that the market does fluctuate, which is why it's important that you make sure as an estate agent, you're constantly marketing, you're fueling that machine so that when buyers and sellers do return, you're the first port of call, you're the first one that they remember. So outlook for the second half of 2022, as I've already said and super highlight, markets holding up really well in the face of uncertainty and higher borrowing costs. There are fewer buyers than there were a year ago, which means that the market is finally balanced. Again, we're seeing about 50% of properties coming to market selling, which is why it's finally balanced. Go below 50%, you're more of a buyer's market. You get ahead of 60%, you start going into a seller's market on that. So more sellers are entering the market, suggesting households are pressing ahead despite all this uncertain backdrop, and that's going to help support sales. I don't think we'll hit the 1.2 million transactions we did last year, but we're certainly not going to be far away from that, maybe around the 1.1 million mark, which is not to be sniffed at. Right, onto nationwide. So monthly down 0.6%, up 1.7% annually. So that's house prices were down month for month, should I say? Where are we? So they were down month for month for the first time since December. That's what I wanted to get at. Scroll down here, I share this every time, but look at UK house price to earning ratios, actually in line with the 25-year average, which is why we're still seeing pretty normal transaction levels for recent decades, even with all the uncertainty out there. So Robert Gardner said, given the uncertainty caused by developments in the Middle East and the subsequent rise in energy prices and interest rates, there has been some loss of momentum, which was to be expected, of course, but consumer confidence has weakened notably since the start of the conflict, and the GfK's headline index fallen to its lowest level since late 2023, with only a marginal increase in May. Major housing market sentiment have also deteriorated. Royal Institute Chartered Surveyors reported a sharp fall in new buyer inquiries in March, taking the index to its weakest reading since 2023 and remained deep in negative territory in April. I don't typically report on the Royal Institute of Chartered Surveyors report, so I find it incredibly negative. And I am realistically optimistic when I do these reports, just as an FYI. He goes on to say that nevertheless, economic growth is likely to be somewhat weaker and inflation higher than previously expected this year as a result of developments in the Middle East, although the impact will ultimately depend on the duration of a shock and the policy response. The UK economy and the housing market have proved remarkably resilient in recent years. Household finances are solid, total household debt at its lowest level relative to income for around 2 decades, and sizable saving buffers have been built up through, though these are not evenly distributed across households. It's a really key paragraph there to let the public know finances are solid, household debt is at its lowest level for a couple of decades, and people have got savings. We're not where we were 15, 20 years ago, which is what the negative commentators keep trying to get across. So housing affordability has been improving steadily in recent years due to a combination of income growth outpacing house price growth by a wider margin, and then a modest decline in borrowing costs. Whilst interest rates, of course, have risen in recent months, the impact on affordability has so far been modest. Swap rates, which underpin fixed rate mortgage pricing, remain well below the highs reached in 2023 and are broadly in line with the levels we saw in 2025, 2024. And that is implying that only a partial reverse of earlier gains. This provides some confidence that if the latest shock passes relatively quickly, energy prices normalizing in the course ahead, any near-term softening in the housing market will also prove short-lived. Fingers crossed for that. On to Halifax. So I probably say this each month. The Halifax data is always a month behind because their index doesn't come out for another few days. So I'm always reporting a month in arrears. Their average house price sits at 299, down monthly 0.1%, up quarterly 0.2%, and annually up 0.4%. So Amanda, head of mortgages at Halifax, says that the pace of annual growth has eased 0.4%. After a strong start to the year, the global developments have added a greater degree of uncertainty to the outlook. In particular, the higher energy prices have fed into inflation expectations, prompting markets to reassess the path of interest rates and shift that has already pushed up borrowing costs for many buyers. Understandably, that leads to more caution amongst some households. Cost of living, once again, is at the front of mind, and extra thought being given to planned property moves. Even so, the housing market continues to display the resilience that has been its hallmark of recent years. Activity is likely to cool in the near term, but the underlying picture remains one of relative stability, supported by wage growth that continues to outpace house price inflation. Another important factor is that the majority of existing homeowners are on fixed rate mortgages. I think it's about 85-90%, and that means that they're largely insulated from short-term changes in interest rates. A slower pace of house price growth may be disappointing news for existing homeowners, but for those looking to step onto the property ladder, stable prices is certainly helpful. And if higher mortgage rates mean affordability, even if, sorry, housing affordability remains higher and stretched because of increased mortgage rates, the average price paid by first-time buyers has fallen slightly to its lowest level so far this year at just shy of 239,000. So on to eServe. So almost at the end here. So Great British house prices are at 327,800, up 1.7% year on year, and up 0.2% on the month and 0.3% on the quarter. I won't go through the regional stuff. This has pointed to a market that's still moving forward, but without strong momentum. The headline masks a wide range of regional positions. Most regions still recording annual house price growth, but London's moving in the opposite direction. The spread between the strongest and weakest regions is now 8 percentage points. The small monthly and quarterly gains show there is still support for prices, but the pace remains steady rather than strong. Without a clear improvement in affordability of mortgage rates, national growth is likely to remain modest. You see a recurring theme here from each index. They might say slightly differently things, but they're all saying the same thing. Modest house price growth, transaction levels steady, just everything is pretty steady. Things are not going crazy, whether that's in a positive way or a negative stuff. They're just chugging along slowly but surely. And let's go down here. Don't want to touch too much on the regional stuff. So let's end on the outlook. So the near-term outlook remains steady rather than strong, as I just said. Prices are still rising, but it's modest monthly and quarterly growth, suggesting that the pace is easing. So again, remember those sellers who are trying to chase the market. Well, if affordability is 5 to 10% worse off than it was a few months ago, just remember that if you keep your price where you are, if that buyer's affordability has come down by 5 to 10%, you're now 5 to 10% above the market, if that makes sense. So mortgage pricing remains a key challenge. Volatility in gilt yields and swap rates driven by global and domestic uncertainty is feeding through into mortgage rates and keeping affordability under pressure. Whilst momentum is easing, overall market conditions remain relatively resilient. More affordable regions will remain better supported whilst borrowing costs stay elevated. I've said that before. London looks more exposed, but the pressure is not spread evenly. The inner boroughs and flats are bearing most of the strain, while outer London is softening. Obviously, the closer you get to central London, the worse it is. Flats are having an absolute shocker at the moment. I remember one of my friends coming to me about a decade ago wanting to buy a new built flat in London, and I said, "Are you crazy?" I think they sold it a few years later and lost about 50 grand on it. And they took my advice second time round when it came to buying a property. So if you can, you should always try and stretch yourself and buy a house. Go for freehold, not leasehold, in my opinion. So final paragraph: a picture is not one of broad-based weakness, but increasing divergence. Very fancy words. Growth remains modest overall, but pressures are concentrated in London, particularly in the boroughs and the flats market, where more affordable areas continue to hold up. Affordability rather than demand remains the key constraint. So, last bit on land registry, annual house price change is 0%. So that was right in my update. It just missed the percentage off. Monthly, it's down 0.4%. And then if we look at that from the figure point of view, so latest data sits at 268. A year ago, it was 268. It's dropped a little bit since the peak of last summer. We've obviously gone into a very nervy autumn budget. We've then gone into the conflict in the Middle East, and house prices are not far off where they were at that point, which is a positive to see. So that is the May 2026 UK property market update. Thank you very much for watching. I will be back in early July to report on the first half of the year, how crazy it's gone that quickly, and also how things went in June as a month as well. If you've got any questions in the meantime, please do drop me a DM. If there's any feedback, anything you want removing, including for future editions, I'm all ears for feedback. Thank you very much for watching, and I will see you again next month.